Hello, and welcome to our latest economic and industry update, once again brought to you by Greenbrier's marketing team. I'm Mallory Moran, and I'm joined by Jay Carter. So the gross domestic product, known broadly as GDP, is a macroeconomic measure of how many goods and services a country produces. It provides a nice snapshot of an economy's health. So Jay, what is the U.S. GDP forecast?
Thanks, Mallory. I'm glad to be here with you again to provide this update. The U.S. GDP declined 1.4% in the first quarter and was driven mostly by reductions in exports due to the dollar's strength and high exchange rate, followed by a reduction in business investment in inventories. Furthermore, the GDP forecast has been revised down again to 3.2% in 2022 and is forecasted to be 2.2% in 2023 due to inflationary concerns. Now, the labor market recovery has been exceptional in recent months. In March, the national unemployment rate was 3.6%, significantly lower than the 6% from a year ago, and only a tenth percentage points above pre-pandemic levels. Now, for all intents and purposes, the Fed has accomplished the employment side of its mandate.
Inflation continues making headlines and has reached 40-year highs, not only in the U.S., but throughout the world. Continued supply chain issues and Russia's invasion of Ukraine are leading contributors to inflation and economic uncertainty. Jay, do you anticipate inflation will continue?
There's too much uncertainty to forecast inflation for the long term. However, in the short term, the Consumer Price Index, known as the CPI, which measures the prices paid for consumer goods and services, is expected to average 7% in 2022 and then fall to 3.2% in 2023. Now, we expect the Fed will increase interest rates to combat inflation. It's important to note also that household savings is $1.2 trillion, which is still incredibly strong and should help consumers offset some inflationary pressures.
Jay, you briefly mentioned the Fed. How do you anticipate they will help the economy?
I anticipate the Fed will tighten monetary policy. As I said, the labor market is recovering exceptionally well. Payroll employment increased 431,000 jobs in March of this year. Stronger employment will support and sustain consumer spending, as we saw consumer spending increase 2.7% in the first quarter.
As I mentioned before, the war in Ukraine is also contributing to inflationary and supply chain pressures. Russia, Ukraine, and Belarus produce a large portion of the world's wheat, fertilizer, energy products, and steel. Worldwide production changes will produce opportunities for certain sectors. For example, Canada is a large producer of fertilizer and crude oil, capable of increasing their production. Jay, let's now transition to the narrower freight economy, and how do you see these dynamics affecting railcar loadings?
Year to date, railcar loadings are down about 4%, with coal loadings being the highest growth commodity. Now, coal's resurgence is due to elevated natural gas prices. And I anticipate this will continue until natural gas becomes more affordable. An increase in crude by rail is likely if the difference between Canadian and U.S. produced crude is $15 to $20 per barrel. And I anticipate this to likely be a tailwind in the second half of the year and into 2023. There's also rising covered hopper demand across commodities, including sand, grain, potash, and plastic pellets.
These shifts in rail loadings will further impact network velocity, which, as most of you know, has been poor lately. Velocity is down over 4% compared to last year, with the East Coast Class 1 railroads seeing the biggest decline. BNSF and then Union Pacific are imposing embargo measures on railcar loads in an effort to meter traffic and improve their network's fluidity. The Surface Transportation Board, one of rail's governing bodies, has been conducting hearings on this very issue and its impact to shippers. Jay, what's your take on velocity?
Well, Mallory, the true issue affecting rail service is a shortage of train crews and the inability to hire quick enough to maintain fluid networks. I expect it will take some time to see improvements. Due to China's COVID-19 zero tolerance policy, there are over 500 container ships waiting off the Chinese coast. That surge in containers will take months to reach U.S. ports. So hopefully these fluidity issues are addressed before then. That being said, total rail cars in storage decreased for the 21st consecutive month to about 288,000 units, about 17% of the North American fleet. Now, this is a roughly 16,000 unit decrease from the prior month and the lowest we've seen in years. And we anticipate new railcar demand will continue.
During our last update, we mentioned that the industry's railcar backlog grew to nearly 43,000 railcars. This demand is impacted by numerous factors, including railcars in storage, rail scrapping rates, and commodity prices. Jay, what do you anticipate regarding railcar scrapping this year?
During the month of March, there were roughly 3,800 railcars scrapped. And we're estimating that roughly 43,000 railcars will be scrapped this year, which is a reduction from last year's historic scrap rates. The price of steel is a big factor in scrapping and new railcar builds. In April, the weekly domestic U.S. steel prices stalled for the first time since early March following the invasion of Ukraine. Conversely, steel lead times continue to be elevated, rising to 6 to 7 weeks versus the previous 5 weeks.
That makes sense. Overall, the theme continues to be significant pressures on commodities and supply chains, impacting areas across the broader economy, as well as the rail industry specifically. Any final thoughts, Jay?
I'd like to leave the message that, we need to continue to be strategically proactive in navigating the current rail environment. While there are greater risks within the economy and industry, there are also greater opportunities. Just remember this, teamwork makes the dream work.
Thanks, Jay. And thank you for joining us. We hope you'll find this video valuable. Be sure to check out next quarter's edition.